Imagine Cloud9 Coffee has had a chaotic month. It sold lattes. It paid baristas. It earned a little interest because its cash was sitting in the bank, being financially responsible for once. And then, because the universe loves paperwork, it paid income taxes. On an income statement, those items do not all belong in the same pile. A classified income statement is basically accounting's way of saying, please organize your chaos before the professor sees it. Here is the one question that makes this way easier. What produced this revenue or expense? If it came from the company doing what it was built to do, it is probably operating. If it came from something peripheral, incidental, or non-core, it belongs in other, also called non-operating. An income tax expense gets its own final stop on the route. Let's walk through it using Cloud9 Coffee. First up, operating activities. These are connected to the company's primary business activities, the reason customers show up in the first place. For a coffee shop, selling a caramel cold brew is operating revenue. Selling a breakfast sandwich? Also operating revenue. The shop is doing coffee shop things. Revolutionary, I know. The expenses that help create those sales are operating expenses too. Coffee beans, milk, cups, barista wages, store rent, advertising, and the electricity required to keep the espresso machine from becoming a very expensive countertop sculpture. Those are tied to the core business. So operating is not just good stuff or bad stuff. It is the activity that shows whether the actual business model works. For Cloud9 Coffee, can it sell enough caffeine to cover the cost of making and selling that caffeine? Now picture this. Cloud9 had extra cash in a bank account and earned interest revenue. Nice. But is the coffee shop's main mission to sell coffee or to become Wall Street's tiniest hedge fund? Coffee. That interest revenue is usually an other or non-operating item because it did not come from serving customers. Same idea with interest expense on borrowed money. Borrowing can help fund a business, but paying interest is a financing cost, not the cost of steaming oat milk. Gains or losses from selling an old espresso machine can also appear in other income and expenses because selling used equipment is not the core product line. If your cafe suddenly makes more money flipping espresso machines than selling cappuccinos, congratulations. You may have a different business. Why does this separation matter? Because someone reading the statement wants to know two different things. First, how profitable was the core business? That is operating performance. Second, what else affected the final profit this period? That includes financing, incidental gains or losses, and other non-core activity. Mixing everything together is like grading a student's exam score, internship pay, and lucky scratch-off ticket as one academic performance number. Technically, money happened. But the story is a mess. After operating items and other items, the company arrives at income before income taxes. Then comes income tax expense, the tax associated with that pre-tax income. Think of it as the final checkpoint. Cloud9 Coffee has figured out what it earned from coffee, what happened outside of coffee, and then the tax system shows up with a clipboard and a deeply committed energy. Subtract income tax expense from income before income taxes, and you reach net income, the bottom line. So remember the classification shortcut. What produced this revenue or expense? Core business activity? Operating. Peripheral? Incidental? Or financing related? Other or non-operating. Tax on pre-tax income? Income tax expense. Once you see the story behind each item, a classified income statement stops looking like a spreadsheet forest and starts looking like a map. And unlike group project maps, this one actually tells you where things belong.